This content is for educational purposes only and is not financial advice. Any results shown are illustrative, not a promise or guarantee of similar outcomes, and individual results vary. Options trading involves high risk of loss.
Hello, in today's video, we're going to take a look at the Thursday, July 2nd, 2026 trading session for the SPX CBOE index. We'll be utilizing two different indicators. One is the day trading GPS SPX daily key levels V3.0 indicator, and the other one is our newest indicator, our ribbon V3.0 indicator. In today's video, we're not going to go into all the details about the trading strategy and all the details about the different levels and features of the SPX daily key levels V3.0 indicator. We're mainly going to look at the trade setups, how we determine the entry signals and trade entry confirmations, as well as managing the trade to its finality. Okay, so let's get started. So first off, we have the opening 9:30 a.m. candle here, which is closing above today's bull bear key price level given by the indicator of 75.0395. However, we're not just going to go on candle closes alone. With this particular strategy, what you're looking for is a candle close above or below either a main key level or a contextual key level. But you're not going to enter just on that entry signal. You're also going to wait until you get confirmation from the ribbon indicator. Confirmation from the ribbon indicator is on a bullish trade, an all green ribbon with the upper bands of the all green ribbon starting to pull away from the base. Conversely, on a bearish trade, on a candle close below a main key level or a contextual level, you're looking for the reverse. For confirmation, you're looking for an all red ribbon with the lower red bands of the all red ribbon pulling away from the base of the ribbon. Now, as far as this entry, we don't really get that confirmation from the ribbon until the second candle here, or one of these succeeding candles here. So the 9:32 a.m. candle is our first entry opportunity here. Now, if we turn the reset filter off, you can see how a standard ribbon looks. We have an all green ribbon here with the bands pulling away. However, these bands are pulling away because of the effect of the gap from yesterday's close here and the gap open here. So that can be a problem with standard ribbons, is that you have this hangover effect, which is most prevalent on an index such as SPX, which does not trade in the pre-market. It has no overnight session on the SPX CBOE chart. So in that case, you're always going to have a gap up or a gap down. And right now we're at the 7,400 to 7,500 range. So usually the gap up or gap down is fairly significant. And in some cases can be quite extreme, as we've seen in some sessions recently. So the problem comes in is that unless you have a reset filter for trading a symbol such as SPX CBOE, the problem comes into play that you're looking at information that's not exactly true here on a standard ribbon. When you have the reset filter on, you're looking at the true nature of what exactly is going on right from the open. Now, one thing you have to keep in mind when you have this reset filter on is that typically your entries are going to be the second candle or after. The first candle is always going to be on the reset. So depending on what chart time frame you're on, the recommended chart time frames for this daily key levels trading strategy for SPX are between 1 minute and 5 minute chart time frames. The recommended chart time frame between 1 minute and 5 minute is the 2 minute chart time frame, and that is the chart time frame that you will see on all of our videos on SPX on this channel, because we have found that it's the most consistent performer between the 1 minute to 5 minute range. However, you can use the 1 minute, 2 minute, 3 minute, or 5 minute because the process is the same as far as entry signals and confirmation before entering a trade on the 1 minute, 2 minute, 3 minute, or 5 minute chart. And you'll get different looks on a 1 minute versus, say, a 5 minute. And in fact, earlier this week, we did a video on different chart time frames and how this daily key levels options trading strategy works with these indicators on different time frames besides the 2 minute chart time frame that we typically show. We had a lot of traders sending us questions about that because they prefer trading on, say, the 1 minute, 3 minute, or 5 minute. So the answer is that the process is exactly the same. The opportunities may be different on a different time frame. So for example, in a 1 minute time frame versus a 5 minute time frame. And in that video we posted earlier this week, which that link to that video is in the description of this video, and I would encourage you to watch that. It clearly shows that there were more trade opportunities on the 1 minute chart, starting off with bearish trade opportunities to start the session, followed by bullish trade opportunities later on in the session. Whereas on the 5 minute chart, with the ribbon reset on, we were spared the early bearish trade, in which if you had taken that trade on that very large opening down 5 minute candle, you would have immediately gotten stopped out and started out your session with a loss. However, with our daily key levels trading strategy and using both the entry signal, the candle close above or below, and ribbon confirmation, when you're switching to a different time frame, the process is still the same. And in that 5 minute chart on that particular video, you saw where, or you will see if you take a look at the video, that instead of a bearish opportunity right off the bat, on the 5 minute chart, there was no bearish opportunity because there was none presented, even though we had that big down candle on the 5 minute chart. And we had an early bullish opportunity off the 5 minute chart using the same process of a close above a key level or a contextual level, followed by confirmation for the entry from the ribbon indicator. So the takeaway is that the process is the same whether you're on a 1 minute chart, 2 minute chart, 3 minute chart, or 5 minute chart. The opportunities may be different or less frequent or more frequent. However, the process is the same, the system is the same, and it works in a good way regardless of 1 minute, 2 minute, 3 minute, or 5 minute, because we have a two-pronged system of candle close above or below a main or contextual key level that must be confirmed by the ribbon indicator. The ribbon automatically adjusts to the chart time frame that you're on. So in that aspect of it, it compensates for the chart time frame and allows you to use either a 1 minute, 2 minute, 3 minute, or 5 minute effectively with this two-pronged system. Okay, so let's just get back to today's trade. 9:32 a.m. candle. The close of that candle, the ask is $22. Now, you have two other options that you could use with this strategy. The reason that it's the 75.05 call option is that is the closest strike to the level that we're basing the trade on, the bull bear key price level, 75.0395. The closest strike to that is 75.05. So that is your standard play. However, under the standard daily key levels options trading strategy, there are two out of the money options that you always have available to use as well. And how you figure that out is that on bullish trades, you look to the midpoint level above the level you're basing the trade on, 75.1523. So in this case, the first out of the money option that you could consider would be the 75.15 call. The second one would be the one level away. That's R1, 75.2650. So that would be the 75.25 call option. So you could use either one of those three options. If you don't want to use the standard play one because of the cost involved being 22, that's going to be $2,200 per option. You can simply use one of the other two. We also have an early session lotto option strategy, as I mentioned earlier. That's covered in another video, in which reduces the price of the options significantly, even from the two out of the money ones that were looked at here. We're not going to go into that early session lotto option strategy today. But we do go into full details on that, as well as the late session lotto option strategy and how they differ between each other, and then how they all differ between the standard options strategy in that particular video. So take a look at that. The link to it is in the description of this video. Okay, so we have an all green ribbon, candle close above. Tight stop loss is the QL level below the level that we're basing the trade on. The standard stop loss, midpoint level below. If this was a bearish trade, as we'll see in our second trade, the tight stop loss would be the QL above a bearish trade off the bull bear KPL, whereas the standard stop loss would be the midpoint above. Now, there's 4 different targets that you can choose from, depending on what type of initial target that you would like to use in your trade. You have a micro scalp target, regular scalp target. You have a regular day trade target, which is the minimum threshold move. And then you have a regular day trade target, which is your minimum ideal move. The micro scalp target is not always going to be available. That's because there's a couple of conditions attached to it. First, I'll just explain the regular scalp target before we get into the micro scalp. Regular scalp target is a key level that is one full key level away, one full level away from the level that you're trading. In this case, bullish trade off the bull bear KPL, R1 is the scalp target. A micro scalp would be a contextual level, one of these 5 contextual levels: pre-market low, pre-market high, YDH, yesterday's daily high, YDC, yesterday's daily close, YDL, yesterday's daily low. If one or more of those 5 contextual levels happens to occur before the one level scalp, regular scalp target, then you can use that as a micro scalp, as long as it is far enough away from the entry candle. In this case, it is far enough away. If one of these or both of these levels were, say, where this midpoint level was, then they would be too close. As you can see, this is the entry candle, and then this is the midpoint level here. The reason why the contextual levels are used instead of, say, midpoint levels is because of the magnet effect of the contextual levels. Price is typically seeking out in any given session these contextual levels: the pre-market high, the pre-market low, YDC, YDL, or YDH, depending on the volatility of the session. In lower volatility mean reverting sessions, PML and PMH is sought out most frequently. In other sessions, YDH and YDL and YDC are sought out. In some sessions, price will touch or test all 5 of them. In other sessions, you may only see 1 or 2 of them tested. Okay, so in this case, PMH and YDH qualify for micro scalp. If they were too close, then you would just use the one level move away for a regular scalp. Regular day trade, there's 2. 1.5 level move, that's your minimum 1.5 level move required for a regular day trade. 2 level move would be R2. 1.5 level move, mid R1, R2. Why is the 2 level move called the minimum ideal move? That is because in 80 to 85% of SPX sessions in a normal year, in a normal volatility environment, the average daily range will be between R2 and S2 here. That doesn't mean that price will travel up to both of them or up and down to both of them. Some sessions, price will just travel up from the bull bear KPL and never go below it. In some cases, the reverse. It starts out below it and never goes back above it. The point is that the average daily range in 80 to 85% of SPX sessions is generally contained within a 2-level extension above the R2, excuse me, a 2-level extension above the bull bear KPL to R2 and below to S2. That is why the minimum threshold is set at the 1.5 level, because that still gives you room to adjust your trade if we happen to get a session that goes beyond R2 or beyond S2. Now, in the remaining 15 to 20% of the sessions, the majority of those will be lower volatility mean reverting sessions that will generally range from R1 down to S1, or in very choppy, lowest volatility sessions, midpoint above to midpoint below the up and below the bull bear KPL. Whereas the minority of those remaining 15 to 20% sessions will see price travel beyond R3 or below S3. Okay, so what about what you do at the targets? There's several different options at each target. The options are as follows. All of these options apply whether you're using the microscalp if it happens to be available, or the regular one level move scalp trade, or either one of the two regular day trade 1.50 level or 2 level. And they are as follows. When the price hits your intended target, whether it's microscalp, regular scalp, or one of the regular trade targets, you can, of course, just exit your trade 100%, regardless of how many contracts you have. You just simply and cleanly collect your profit and exit the trade. Second option is adjusting your stop loss to break even. What we mean by that is not changing your stop loss to the candle close level that you entered at or at the key level that you based the trade on. You're instead changing it to the price you paid for the option. So for example, $22, you're changing your stop loss to $22 on all of your contracts, or you're changing your stop loss to break even plus an additional profit buffer of 10 to 20%. In this case, roughly $2 to $3. Then what you're looking for is a move up to a further key level move in your favor. What does a further key level move in your favor after the initial target mean, regardless of whether your target's a microscalp, regular scalp, 1.5 level move, or 2 level move? It means any contextual level, main key level, or midpoint level. The only ones that are not included are QL levels. So after price hits your target, whether it's microscalp, regular scalp, 1.5 level move, or 2 level move as your initial target, if you have any contracts where you're adjusting your stop loss and you're looking for a further move in your favor, for trend to continue in your favor, then at each succeeding further key level move in your favor beyond the initial target, then at those points, and each time it hits one, then you're either further adjusting your stop loss by adding more profit buffer and staying in the full position, or taking off some of the position by closing out and exiting some of the position, or exiting all of the position. Now, what is the third option? A combination of those two. This applies if you were trading 3 or more contracts, because in this option, you were closing out the majority, i.e. 60 to 90% of your original position when it hits the initial target. And then what you're doing then is you are de-risking the remaining contracts by moving your stop loss to break even, the price that you pay for the option on those remaining runners, or break even plus an additional profit buffer on the remaining runners. Then on the remaining runners, you're managing those by also using the ribbon to gauge further trend continuation. And at each key level or contextual level that happens after the initial target is met, then with those de-risked runners, you then have a decision to make at each time it hits one of those key levels, to either further adjust your stop loss on those remaining de-risked runners by adding more profit buffer each time it hits a further one in your favor, or exiting all of your remaining de-risked runners when it hits, one of those levels, or doing a combination of exiting some of your remaining runners and adjusting a stop loss on whatever happens to be remaining. A lot of it just really depends on how many you were starting off with. For example, if you started off with 3, then closing out 2 is 66.67%. If you're starting off with 4, closing out 3, then that's 75%. Starting out with 5, closing 3, that's 60%. Starting out with 5, closing 4, that's 80%. Starting out with 10, closing 9, that's 90%. This really depends. The main point is closing out the majority, 60 to 90%. So this works more on closing out the majority of your contracts, not starting off with 2 contracts and just closing 1. You could do that. It's not really recommended. It's really up to every trader to decide for themselves. But the process works better if you're using it to close out the majority of your contracts. What you're doing is when it hits the micro scalp, regular scalp, regular trade 1.5 level or 2 level move, you're closing out 60 to 90%, and you are collecting those profits at that time, closing out 60 to 90% of your position, and only the remaining contracts are still in play. And on those, you're changing your stop loss to at least the price that you paid initially, the executed price you paid for the options. You can also just add a very small amount if you want to cover any possible slippage on getting stopped out. So for example, $22 instead of adding 10 to 15% for a real profit buffer. If you just wanted to do it to cover possible slippage, then say $20.20, $20.30, $20.40 as an example. Okay, so as you can see here on this 9:40 a.m. candle, it hits the contextual levels, PMH and YDH. So at that point, that's your decision there. Exit everything, adjust your stop loss on everything, or if you're doing multiple contracts, exiting 60 to 90% and adjusting your stop loss, de-risking your runners on remaining. Here on this candle here, 942, hits R1, the regular scalp. Then same process. That was your target, same process, same decisions. 9:50 a.m. hits the mid R1, R2, that's the 1.5 level move. Now, when it hits that on 950, when it hits 950, $36.70 is the bid on this candle here. As you can see, it did spike through it, backed off a little bit, still closed slightly above it. $36.70, profit $1,470 per contract on the standard play, the 75.05. Obviously, your profits would be less on choosing the other alternatives, either the 75.15 or the 75.25. We're not going to go into those today. Again, you can look at the other video. It's in the description, link to it in the description of this video, which is about an 1.5 hour long video. And it goes over the full strategies, including all of the option strikes and all of the strategies and how they compare. And you can see how they all play out. As you can see here, if you stayed in any of the position, didn't exit the entire position, or any de-risked runners that you had, eventually they would have gotten stopped out as we do get a reversal. Ribbon is transitioning here. Price is closing below both of the thick yellow MA lines within the ribbon. But here on this 10:40 a.m. candle, we get a close below a main key level, bull bear key price level again. Ribbon is all red, lower bands pulling away from the base. So that is the bearish entry, $18.40 is the ask. Same process. Closest strike to this, 75.05, in this case a put. We're going to look at the two out of the money ones. Then you look at the midpoint below, 74.9268, so that'd be the 74.90 put. S1, 74.8140, that would be the 74.80 put. Tight stop loss, QL above. Standard stop loss, there's midpoint above. We have a microscalp opportunity here with the YDC level. As you can see here on this 11:06 a.m. candle, it takes out the YDC level, the regular scalp level, which would be S1. That's the one level move away on this particular bearish trade off the bull bear KPL. And it also takes out the 1.5 level move on the regular trade, mid S1, S2, all in this candle. For a 1 minute chart, it's going to look differently. 1 minute chart, you'd have the opportunity to probably adjust at the YDC S1 level before it hits mid S1, S2. Now, when it hits that 11:06, bid 38.30, profit $1,990 per option. As you can see here, this move does have follow through. It does continue on. With the ribbon, when you're managing your trade, you're looking for the ribbon to continue with the same color. There are going to be times after you're in the trade that it is going to stair step back like this. And then on bullish trades, it'll stair step down and then resume. So that's the most common occurrence. Step down, retrace, step down, retrace, step down, retrace, step down. And then finally, as you can see here, we're finally getting somewhat of a turnaround here. However, it's very late in the session. Generally, what you're looking for is on a bearish ribbon here, you're already in a trade. You don't want to see price start closing back above the MA yellow line above. Bullish trade opposite the MA line below. This is fairly normal here, although a lot of times you will just see retraces just back to here and won't even breach this one. What's more often common is that it will test these, go into the middle zone of these and test these, but not start closing candles above this, or in the case of bullish one, below that. So this helps you engaging further momentum in your favor for continuing, as we talked about, in other contextual levels, midpoint levels or main key levels that occur after your initial target was met. So here, since this candle took out all three of these targets, then your next one is the PML, then the S2, then YDL, then the midpoint level here.
Okay, so that's going to wrap up today's video. If you are interested in purchasing the SPX Daily Key Levels V3.0 indicator, email us at daytradinggps@gmail.com to request a discount promo code. Subject line SPX promo code. You can either request a promo code just for the SPX Daily Key Levels indicator by itself, or for our SPX suite, which includes the SPX Daily Key Levels indicator plus the ribbon V3.0 indicator, plus it includes a third indicator, our special VWAP indicator for SPX and XSP. If you look in the description of this video, if you go to the video that we posted earlier this week, the link for that on the chart time frames, 1 minute versus 5 minute. In that video, we go over why you need the special SPX VWAP when trading SPX CBOE or XSP CBOE on TradingView. Basically, the global indices feed for TradingView that they get from CBOE for the SPX index and the XSP index does not include volume data. So that's why none of the native built-in VWAPs on TradingView work on SPX CBOE or XSP. And in that video we show that you'll basically just see on the native VWAPs a red exclamation point with no data volume. Our VWAP uses an external institutional grade SPX volume. So Our VWAP does work on SPX and XSP, so that is also included in the suite. So you get 3 indicators in the suite. So when you do email us requesting a promo code, just let us know if you want the promo code for just the indicator itself, or if you'd like it for the total SPX suite, or if you just want to get both and decide later. To purchase, simply go to www.wap.com/daytradinggps. You'll see our storefront on WAP that has all of our daily key levels indicators and all of our suites. We like to close out the video by showing you feedback and reviews that we've received from people who have bought our indicators and use them on a daily basis. So we'd like to show you some screenshots of some of the feedback and reviews that we received. You can also just go to that website storefront, www.wap.com/daytradinggps. Click on the reviews button, and then you can read through all the reviews that we've received and all the feedback we've received. Thank you again for taking your time for watching today's video, and we wish you much prosperity and wish you a happy 4th of July.
For those interested in seeing how other traders are using the indicators and the daily key levels trading framework, here are some reviews and feedback we have received from customers who have purchased and used the indicators. While individual results will always vary based on experience, risk management, and execution, these reviews provide insight into how traders are incorporating the daily key levels indicators into their own trading processes. You can view additional customer reviews and feedback at daytradinggps.com. Thank you.